We have officially hit the noon hour in the Eastern Time Zone, and that means we are about to have our Trader Roundtable. This has been a pretty popular segment with the listening community, so we wanted to give you an opportunity to ask some questions for our trading team, and I'd like to welcome in everyone. Good morning, gentlemen.
Hi, Jim.
Morning, Jim.
And
Morning, Jim.
Good morning again to you all. So I'm going to start you guys off with a nice, easy one because I think I already know the answer to this one. So the first one is going to be from one of our listeners. Should investors be reducing exposure to markets now in anticipation of the 2020 elections?
I could jump on that one. I wouldn't be trading off anything on 2020 elections at the moment. I mean, it's just way too early to be focused on that. What is there? 14 Democratic contenders at the moment. I mean, you know, if you think about it, in 2014, Trump wasn't even being really mentioned at this, or 2015 around this time, Trump wasn't even really being mentioned all that much. You know, it was kind of viewed more as a celebrity ploy. So I wouldn't be using that 2020 elections for my investment portfolios yet. I mean, we want to keep an eye on it, but you know, I don't know what you'd be not necessarily trading on going into there. We just got to see how that goes out. I wouldn't be worried too much about that yet.
Yeah, let's make sure we get a 2-year subscription from that subscriber until 2020.
Yeah, I would guess based on most of your time frames that this would be something that wouldn't even come into play until it's a thing, and that's literally maybe you guys might reduce exposures closer to the Democratic or Republican conventions, just the big key events, especially considering we have zero certainty as to what the makeup's even going to be come, you know. We got so many questions coming up on the horizon that this seems so far out right now.
Yeah, this is Chart Trader. I would agree with all of those assessments. I think that it's too far away eventually to shape a narrative that's not necessarily one directional. It's not necessarily about risk aversion. It's going to be both directions, and based on whether or not you're going to have you know, the White House lined up with Congress or not, and whether you're going to have the right or the left in the White House and the right or the left dominating Congress, and which policies people are going to like most, and whether or not the parties can start to work together. So there's going to be a ton of different intricate dynamics, not just a generalized notion of getting out of the way of the elections, because you can't get out of the way of something that could ultimately be a big boost. You know, depending on the likelihood of big infrastructure packages and things like that based on the makeup in Washington, D.C. So I think there's going to be a narrative there that's going to start earlier than usual, but it's not necessarily the case that that narrative is bearish.
Yeah, and let's just put this in into a constructive time frame. We're talking, what, about 18, 19 months out from the elections, even a little bit more than that. I mean, you could have sold out the night of the election this time around in 2016 and gotten burned by jumping out too early, given, I mean, just look at that overnight action on election night when everything tanked, and you heard Carl Icahn famously say, I left the party and went home and bought $1 billion worth of stocks. So, you know, I don't think you want to go in with the bias of, oh, I got to sell into the elections, especially with it so far out in advance.
All right, I think we're going to touch on a lot of questions that are regarding technical setups and technical ideas that you guys have either individually or collectively. And I'm going to start off with what are your excuse me, I'm going to start off with this one. What are some of the things you look for to avoid false breakouts? This listener, when looking back at his trading behavior, it seems to be one of the areas that he seems to stumble with. So, what are the warning flags for some of the false breakouts?
I jump in here. This is Blue Chip. So the first sign is that you're losing money on the trade. It's that simple.
Well, he wants to avoid them in advance. So, are there any key things, some red flags that you look at that triggers your instincts to go, oh, you know, I think this might be a false breakout. I'm going to avoid this one.
All right. Well, So that's a two. I'll give two answers to that. First of all, loss is a part of the game here. If you're a trader, you have to be willing to lose money from time to time. It's a numbers game where you basically have to let your winners run when they are working in your favor, and you have to cut your losses short when you're wrong. Does anybody actually have a crystal ball or the holy grail indicator that is going to state which breakouts are going to be better than the other ones and not turn into a loser? That the answer to that is obviously no. So what you can do is when you see a breakout in a stock that you like or a particular pattern that you've been tracking, the whole key is managing your risk on those trades. It's not about, in my view, predicting whether the trade is going to work or not. It's about keeping the money and the management under control, and then just taking it from that step further. From a technical basis, and again, I've studied technicals and charts. That's all I do. I have never come up with anything that's significantly stating that one breakout is going to work and one breakout is going to fail. So yeah, maybe I think Brett might want to chime in here too, because he could probably enlighten a little bit more on that.
Yeah, so well, one thing I would add to that picture is one of the things that defines the probabilities around whether or not a breakout fails is the market composition underneath the surface of the market. And it's awfully tough when you're looking at an individual stock, particularly a mid-cap or a small cap, to understand whether or not you've got a crowded long situation or a crowded short situation. But if you're looking at top-down markets, if you're looking at the type of stuff that I often trade, the index plays, then you do have sentiment data, which is really, I think, the main thing that sets the stage for understanding in advance what the probabilities are that a breakout will fail or will extend. If everybody, for instance, let's say you're in a market that's oversold and that there's a lot of really bearish sentiment, and you see a kind of short time frame bullish breakout setup form, maybe it's like a bull flag or an ascending triangle on the intraday chart, and it's happening while there's a lot of bad news hitting the tape. That kind of situation, if you get a breakout, I can promise you it's not going to fail, because the tape is already leaning so short and you've got so many bulls on the sidelines that once you start to break out to the upside, you're going to have shorts cover, you're going to have people come off the sidelines and start to buy in because they've already been scared up by the news, they've been scared up by the tone of the tape. So just take away from that kind of dynamic is what probably defines the probability landscape around whether or not a breakout is going to fail. What sort of positioning situation you have underneath the surface in that market? Are people leaning way short? Are people super skeptical? Or are people really excited and leaning way long and everybody's already in that thing? So the breakout is actually, especially breakouts on headlines, if you've got a market that's really full of a lot of bullish energy, a lot of enthusiasm, a market that's been really strong, a stock that's had a lot of buzz around it, and you get a bullish headline and it pokes above a resistance level, that's far more likely to fail as a breakout setup because you've already got a lot of fast money that's leaning long, and then people are reacting to the headlines and buying in. So the breakout itself comes about as it's not sort of like, it's not a natural or organic breakout that market had to do. People are forcing that breakout because they're reacting to the headline and they're reacting to the buzz in the stock. But the underlying positioning situation is one that's highly vulnerable. If that breakout fails, think of what's going to happen. There's going to be a lot of people who immediately toss it overboard because suddenly they're way out of the money and they're over leveraged because they were overly excited because of the headline and the buzz around the stock. So those are the dynamics, I think, that underneath the surface really define the probability landscape, and that's one of the main reasons why I follow sentiment data so closely, is to get a sense of that next level edge when interpreting the probability landscape around pattern resolution. So I would say if you trade top down, I don't know who this question was from, but if you trade more top down, take a look at sentiment data indicators to get a sense of what the market composition is underneath the surface, because you'll have a little bit of an edge, a few percentage points of an edge in identifying which types of breakouts are more likely to fail.
Yeah, and this is Blue Chip again. So it also depends on your time frame, I think, whether you're a swing trader or a day trader, whether you're trading those breakouts. I would say that the breakouts on a daily time frame are more likely to fail, or intraday basis. Whereas if you're looking more at a weekly time frame, and you're basically trading a stock for a couple days to weeks as a swing trader, you're probably going to have a lot more success. And then the other thing to think about too is you could be trading too much size than you are really willing to accept. In other words, I don't know how how the subscriber is basically saying how they get shaken out. But if they're just getting knocked down on the same exact day, and then the stock is basically reversing in the next day, and then taking off again to the upside without them, they probably have too much size, and their stops are too tight as well. So you got to lighten up a little bit, basically, and you got to give the market the wiggle room that it needs in order to continue that sort of momentum. And if you notice on our site, I don't think a lot of us even trade breakouts. It's very rare.
Don't you trade breakouts a lot, Scott?
I trade the pre-breakouts. I usually do pullbacks and lifts out of consolidation patterns that are setting up for breakouts.
Yeah.
So I'm basically taking the position size right before the breakout happens, and then I'm usually taking profits into that initial spike higher when I know the textbook technical analysis traders are jumping on board. And I'm taking advantage of that move there, and then I'll trade a lot of pullbacks thereafter. Sometimes after a stock breaks out and then consolidates and holds those gains for 2 or 3 sessions, then I'll continue on with the the upside movement post the breakout. But I'm talking about the official breakout day over a clean resistance area. I rarely go after those things. So
let me add one thing to Scott's characterization there. One of the patterns that has worked extremely well for me in the past, and this is on breakdowns and breakouts both, and he kind of alluded to it there, and if you can kind of match these two things together, what I call a failed breakout. So you get a failed breakout, it hasn't worked, and then it can't really pull back, and then it starts to gradually march up and do something that I call eating the tail. That's one of the most reliable setups that I know of. So if you see a failed breakout, usually on some time frame, you can see like a bar tail, like a candle tail, a wick sitting up there. When you fail, you come back down into the pattern, and then you gradually start, just in a grinding way, to move back up through that tail. That's usually a far more reliable breakout setup, once you've already essentially seen the worst that's going to happen if the breakout setup fails, and you've weathered it, and then that market starts to march back higher.
You know, that actually leads into the next question, because one of the listeners wants to know what some of your chart traders and scalp traders' favorite technical setups are, and I think that'll be an easy way to get scalp trader into the conversation. So, scalp trader, what are some of your favorite technical setups that you look for?
Well, I mean, I really don't look for technical setups that much. I'm more of a sentiment trader, short term, so intraday. I'm looking for volatility-oriented stocks, so stocks that have a lot of news or momentum following. I like stocks that have high short interest, smaller floats that have wide intraday ranges. But on a swing basis, I'm more of a fundamentally driven investor / speculator. Again, my whole goal is to maximize gains for the year, and so I find that if I sprinkle seeds, plant seeds across the landscape of different speculative opportunities, 2, 3, or 4 of those a year will really work out for me and provide very strong gains. So like, for example, today I'm scaling into a company called Rubicon Project, ad sales play, small market cap, about $280 million, $80 million in cash. The stock's trading at about 1.3 times enterprise value to sales, which is just super cheap. These ad plays have been really left for dead, but some of them, the ones that are remaining, well, at least a couple of them, put on some TLRA yesterday. They're starting to turn the corner. Rubicon turned profitable this quarter, which is about a year ahead of expectations. And the stock is super cheap. So, I mean, this is one where, you sit back in a year and you can have something that's up meaningfully from current levels.
All right, I'll weigh in on the breakout thing. One of the things that has actually helped me a lot is waiting for the breakout and identifying where that breakout level is, and then waiting for it to pull back right back down to that level. It may take a day, it may take a week, who knows how long. But At that point, you have identified where your entry theoretically could have been had you gotten in on breakout, but you definitely clearly have your risk defined. So what I'd like to do is, many of you have heard me say that I like to be picky in my entries, and by that, part of what I mean is I like to wait for a pullback, so therefore I'm not chasing anything and getting trapped in the potential false breakout. I see the breakout, then I see the reaction, and then I can assess my risk accordingly upon the pullback. So that's my 2 cents on that, and we'll move on to
I'd like to add. I'd like to add something to this particular question.
Oh, go ahead.
So, so I guess there was a point in time that I did use technicals, and I saw that, I don't know, maybe probably around 2010, 2011, you saw like a lot of the algo and kind of high frequency trading shops come in and really destroy a lot of the short-term price action around key levels. So you get the false breakouts, false breakdowns. So I'd like to ask Scott in particular, and anyone else who uses technical analysis, just like what adjustments have you guys made to counter that type of activity, just giving that a lot of these shops are targeting levels and knowing that key levels are really important to a lot of people, and they try to shake the tree around those levels.
Right. So just to clarify that, Damon, you're talking about scalping when you were heavy into scalping, right?
Well, even on a swing basis. I mean, there was a point in time where, like you count on the 20-day moving average or 50-day moving average very consistently to hold a stock, just depending on kind of the overall market conditions. And, it might move like right there within 2-3% of that level, and then come roaring back over the course of a week or two.
Yeah, I understand where you're coming from over the years. Obviously, there's been this big hype about the high-frequency trading and the algos trying to pick people's pockets by, using simple technical tools and then reversing the trades thereafter. That's been isn't that what pit traders and market makers have been doing for years? So basically, as far as I'm concerned, it's no different. I didn't see really much of a different from the way the market's always worked. It was always a human being doing it prior to the technology catching up to it, and then now it's just computers doing it more on a more frequent basis, faster than the rate that the the specialist market makers and the floor traders used to do, just to pick off stop orders at different key levels. Now, one way to compensate for that, I would say, that's why I asked you about scalping, was if you would just switch to higher time frames, because it seems like a lot of algos are running off of 5 minutes and less. And if you would just switch to like a 15, 30-minute or 60-minute time frame, I would say you're going to see a lot more patterns develop that seem to be a lot more reliable. Now, daily time frame, again, it all depends on your time horizon. Even swing trading, I've switch out to the weekly time frame. The weekly time frame, I'm going to get a better sense of the trends that are in play and who's in control for multiple days, as opposed to just that specific day and that specific moment in time. And that's basically the way I've been compensating for it. The second part of that question, I would say too, is I've noticed over the years the technicals work real. To apply technical analysis, just a broad blanket across every single stock, is extremely difficult to do. And I think that if you were to apply technical analysis to, say, certain sectors that are showing relative strength and relative performance, for example, our liquid momentum focus list responds extremely well to basic technical analysis, extremely well to price patterns, to the 20-day moving average, to gap support levels, because it's got that inherent relative strength that's been it's been displaying as a leadership quality. So you kind of have to, again, as Brett mentioned and alluded to earlier, saying how why would breakouts fail? You got to take into context the bigger picture of the market. What type of environment are you in? Are you in an environment where breakouts are actually working and getting follow through, or are you in a very skeptical environment where every breakout you've seen is reversing a day or two after and stopping a lot of people out and then continuing to the downside? And I just think you have to be in the right space and the right group of names to really make your technical analysis excel to a lot of degrees. So
that's a great answer. I hope you recorded that.
Hopefully we keep finding those great sectors and those great leadership things. I mean, obviously the TA page scans and the focus list, those are my wheelhouse, and I like to think I have a pretty high success rate just using basic technical analysis and not trying to overthink anything.
Yeah, and I want to follow Scott up here. This is Chart Trader, and just add one more dimension to this discussion about what I think really comes down to kind of the evolution of the market. So the market is an evolutionary system. It changes over time. There's not one thing that's going to always work. When something starts to work really well, eventually it becomes outmoded as people overcompete in that niche. And it can cycle back around and start to work again. But as people gradually develop bigger and bigger resources for quantitative data crunching, and those resources become more and more widespread and available to everybody, you could imagine a strict, very basic technical system working really, really well in 1905 when nobody else really had charts and you had hand-drawn charts and you were able to calculate things like, the RSI indicator. But when everybody's sitting there, instantaneously available tools of every kind and everybody everywhere, and then you've got big firms that are able to pour billions of dollars into their quantitative strategies, then you're going to start to get some processes where the market starts to manifest signals because people are looking for them, and they start to gradually front run and discount the initial signs of that signal starting to appear. And then it becomes a false signal and people get burnt by it and it goes out of popularity. And that's the process of market evolution, is those sorts of dynamics take hold, take shape, become popular, and then fail and then get out of popularity. But one of the things that stands through all of this is something that I call qualitative analysis, fuzzy patterns. So I used to program trading systems, we're talking like 20 years ago, where I did a lot of programming for futures trading systems, and I went through a process of really kind of going through and pairing up all the indicators and everything. And what I found worked much better was things that a computer had a difficult time defining. Something like, and I've tried to do it, I've tried to get a computer to understand what a triangle is. It's really hard when you get that precise. You can qualitatively understand what a triangle is, but to get a computer to distinguish, because it's all fuzzy, right? It's what is a triangle, what is not a triangle. You can't put one exact line in the sand for the violation of a sloped line one side or the other and say this makes it not a triangle or makes it that it is a triangle. It's a very qualitative kind of judgment call based on your feel of that pattern. And it's really difficult to quantify that kind of dynamic. So there's lots of dynamics that I use in defining my setups where I rely on an intuitive gut sense that the market is showing me that kind of dynamic, that mode of behavior, rather than a specific quantitative signal, which I know can be outmoded by people with lots of money crunching numbers in a data center somewhere in Chicago. So that's qualitative versus quantitative signals, I think, are more durable.
Hey, Brett, let me just jump in there quick. I'm curious to know, because I did a little back testing probably about a decade ago for a while. I didn't have a very robust software to do back testing, and I don't really have a programming language in me, but it was just a basic type of scan that I could basically set up any sort of technical indicator on and then run a back test over, say, 10 years or so, and just see if, if you bought an RSI oversold and held on to it for 3 days, what would be the odds of, winning trade and whatnot. When you did your back testing, I mean, and this is the problem that I had with mine, because the numbers, sometimes they came out great, sometimes they came out bad, but then when you try to apply it going forward, you always lost money. That was the problem. It's like, oh, I found this great indicator, but going forward. And I realized the missing piece of the formula that I didn't have was...
Time machine.
No, it was that I couldn't assess or tell the system, I couldn't ask the system what was the sector doing at the time. I couldn't ask it what the broader market condition was at the time. I couldn't figure out what the VIX was doing. So basically I couldn't put it all into one little thing. I'm sure smarter people do that.
Let me ask you this question. Do you believe that if you could have, you would have come up with the Holy Grail?
No, because I'm still a discretionary trader. So again, day in and day out, I just look at all the tools that I have in front of me, from internal readings and breadth and market levels and sector strength and relative weakness, and then I put this framework together in my head, and then I try to find the one stock that's jumping out of me, setting off an alert, and I tackle it from that risk rewards perspective from there.
So here's my response to your question and also my guess. My response to your question is, if you look at the past 10 years, a lot of other people are looking at the past 10 years too. And whatever's worked really well over that period gradually gets worse and worse through time because it gets out-competed in the niche. I think of it like an ecosystem. And there's suddenly too many predators going after that same prey. You know, and that it generates false signals because the signal ends up manifesting itself simply because people are trying to do it. Like if you've got an oversold stock triggering an RSI signal, you know, people buy it because of that. And suddenly the signal doesn't mean the same thing as before when people weren't buying it because the signal was there. You know, then the signal had meaning. It had a kind of organic, you know, genuine meaning. But the other point is, you've gone through this process, and this is the same thing that happened to me. Going through the process of trying to do what you did and developing your own gut instincts, your ability to make those judgment calls based on your intuition is a system that I would bet on 8 days a week. Because you've developed that. That's inside of you, and nobody can outcompete that niche.
Right.
Nobody's going to have all of those connections. Intuition, I think, is really just essentially when you have such a complex decision-making process with so many variables that it's too complicated for you to tell yourself how you did it. You know, your brain is doing a calculation, but the metacognition is not there. You can't possibly track how many different points of calculation are there and consciously understand how you arrived at the decision, but you did. You're like, I know this is going to happen. And that is the thing that you should trust, and that's the thing that people need to build.
Yeah, yeah. So with that in mind, how do you feel about robo-advisors? You probably hate them, right? You probably think
I think that they're an opportunity. I think they're an opportunity because that's going to be something that breaks.
Yeah, exactly. I agree. Speaking of which, did we highlight, I guess Event Trader, he did post his partial profit out there on Square. Really nice trade there, breaking out over the $80 mark, by the way, so I just got my alert on that one. Nice trade there, Gav.
Thanks, Scott.
You know, one of the things that I found that is tricky for coming up with backtesting strategies is when you do look back and you find, oh, this is a winning strategy, I'm going to start to implement it, you do your backtesting. What I think a lot of people fail to recognize is the amount of times you get the false signal in that time frame where the live market will give you a buy or sell signal, but then it's falsified within any given amount of time that isn't indicated in the results, because you'll get on any given time frame one signal per bar or whatever it is that you're looking at, but how many times that market fluctuates back and forth between a false signal and a true signal, false signal, true signal. And that's where the losing comes in, because people didn't take into account that, well,
the hard right edge.
Yeah, you know what I'm talking about, right?
It's huge. With programming, it's everything. You look at these, you look at a chart, this is one of the biggest things that happens that sells people on systems like this. You look back at an RSI and you're like, oh, look, it went down here and then the market went up. But the signal actually in real time, when you get a computer to try to do it, it wasn't there at the moment you needed to be buying. It's oscillating around whether or not it is actually certainly there. So I think that hard rate edge is an enormously important part of this.
And most indicators are somewhat lagging too. So when you see it, you can look back on a chart and say, oh, look at this crossover right here. Oh, the moving average crossover. Perfect. Well, it's lagged. At the time in which you really wanted to get involved in it, it hasn't crossed yet. So when you do actually see the cross, then you're usually at that point chasing the market in whichever direction you want to go. And I know I'm using a simplified example of a moving average crossover, but it speaks to the point of a lot of times that the indicators are lagging. With that said, there's actually a question here that asks, what are your favorite indicators that you look at when you're looking at different trades?
I guess that's me. So, blue chip here. So we've gone through it before. Everyone should know by now that every morning we focus, or at least I focus mostly on the advanced decline line. It's probably one of my favorite indicators. It's just a broad breadth indicator on the exchanges of whether stocks are advancing or whether declining and which ones are outpacing them. I use that more than I do the major indices, because the major indices are biased towards market cap or price weighting. and they tend to just be relying on a few major heavyweights in those components. Same with some ETFs, and same with some sectors. They're definitely skewed towards particular stocks as a whole. So to get a cleaner representation of just the broad market behavior and strength and weakness, I tend to look at the advanced decline line, both on an intraday basis and on a cumulative basis for defining trends and whatnot. If you've noticed the last Swing Trader column, I posted the cumulative advanced decline line, which recently broke out to fresh 52-week highs. And you would not know that if you were focusing too much on the major indices struggling around their 200-day moving averages. So it tells me that there is definitely this underlying broad market strength in the overall stock market that you're just not going to get if you're just too focused on the major indices in some individual sectors. So that's probably my most favorite one that I go after. Volume, I have the up-down volume ratio. I use that more as a confirmation indicator of whether it's confirming the advanced decline line. That's basically it. I don't use anything by itself in a box. We've mentioned the put-call ratio before. In my experience, it's not the greatest timing indicator in the world. It's more of just a heads-up, another tool to add to that framework analysis that you're putting out there of whether the market is trading more calls or more puts. And when it gets to extremes, like we saw back in Q4, well, then you definitely have more of this mentality that things have gone in too far in one direction. It's not the greatest timing tool in my experience. But it is telling you the current environment that you're in and how you can basically develop a new strategy or short-term plan of attack to capitalize on that environment. And then the VIX, of course, we mentioned that because that's also showing the volatility of the broader market, and same type of scenario there. When that thing gets high, you know that the market action's fast and loose, and you need to adjust your money management and your risk management parameters as well. Maybe even become more of a day trader and lock in profits quicker, or maybe cut back on size of your position size, maybe hedge a little bit more. There's all different varieties and ways to capitalize on it. But those are my main indicators that I watch. That would be the advanced decline line, the up-down volume ratios, put-call ratio, and the VIX. And these are all highlighted throughout this session, usually throughout each day on Trader Audio. And I also posted on the technical take page. I'm just going to pump everything I do here at Briefing, every page I write, and tell everyone to keep visiting them.
No, it's smart because the information's out there. It's just our job to make sure we point people in the right direction on where to find it.
Yeah.
It's just my basic take on what Scott just said. This is Chart Trader. I would agree with basically every word that just came out of his mouth. One thing I will add to it is the put-call ratio is a little bit better as a timing instrument when you've got an extremely emotional market environment. It's not that good of a timing instrument at all. In fact, I don't really even watch it when you don't have. So like when the VIX is over 20, watch the put-call ratio more. It will be more useful. And the other thing is with the VIX, I would say the best way to look at the VIX isn't just to say that when it goes up a bunch, that's when you need to watch out. And that's not at all what Scott just said. What Scott just said was correct. But a lot of people say that in the financial media. They say, oh, the VIX is going up, so now you got to watch out. And it's actually just the opposite. When the market is going down and the VIX is not rising, that's when you got to watch out. Because eventually it will. If you think of the VIX as like a flower in a garden, okay, you see the stem growing up, but there's no flower blooming on it yet. When you get that big VIX spike, that's like the flower blooming. That's the end of that stem growing, right? And the stem is the downward move. So you want to be bearish while you see that stem growing but no flower blooming on top of it. That VIX spike is the time to cover your shorts, not to get short. And you want, if you see a persistent downward trend in the market, and people will say it all the time. I've seen this literally like 30 times in my career where you'll see a segment on like CNBC or Bloomberg where you've got a bunch of analysts come on and go, why is the VIX broken? Boy, the VIX doesn't seem to be working. The market is down a whole lot, and yet the VIX is just at 14. What's going on? The VIX is finally broken. And they'll have some expert come on and say, well, it's because of now algorithms are trading the options market and blah, blah, blah. It's always wrong. That's when you need to be shorting. Whenever you see that kind of segment come on TV, whenever you see that mentality, that's usually the best short. And when you finally see the VIX go from 15 to 30 in a day, that's when you need to be covering. It's that final point, because VIX is a measure of insurance. People are insuring a core holdings portfolio. They're holding the stocks and buying the puts because they're scared of something. That, when you see a sharp, gradual but plodding and significant decline going on in the market, and you don't see the VIX taking off, then what you know is happening is people aren't insuring, they're selling. And when they get down to the core holdings they want to keep, they start insuring rather than selling, and you see the VIX take off, and that's when you cover. So just an interpretive dynamic there, but otherwise, right, I don't believe in a lot of same market indicators. I would rather stick to the fuzzy logic. We talked about the qualitative interpretation, but the extra data you could bring in, and that's really the delineation Scott just made. Looking at the RSI is just looking at price and time, just, you know, kind of recapitulated in a different way. Moving averages are just price and time shown to you in a different way. MACD is just price and time shown to you in a different way. But the VIX brings in new information. The put call brings in new information. The accumulation distribution line brings in new information. All of those indicators bring in new information that give you a context. So I would stick to indicators that bring you new information that give you a context and that can't be gamed.
Hey, Brett, I got a question for you. So,
What's that?
do you maintain a card catalog of analogies, or do you just come up with these on the spot?
On the spot. It is my great gift in life.
Because I use the same analogies over and over and over again, usually
No.
card counting and whatnot. But it seems like you have a new one for us every single time you speak. So
If you want to get a response from Brett in feedback, put it in an analogy and it can't be said.
Yeah, I think we should come up with a communication system based strictly on analogy.
all right, Jim, you can take over the next question.
Well, I got one for you, Brett. Mine is that the market is a sadist and it will inflict as much pain as possible and laugh at you.
Absolutely.
So you have to, you really have to.
Absolutely.
You know what? One of these days I'm going to write a book, The Market is My Mistress, and you know,
Cruel
we'll get
mistress,
yes. So anyway, I don't want to have this get too long, but I do know that this has been a question that gets asked quite a bit, and that's the risk ratio that you guys are using. So let me get this one in particular. So if you guys could, I guess, thumbprint it, what's the typical risk-reward ratios that you guys are using? For instance, chart trader, your 40 ticks on the Dow futures, what were you looking for in that? I know you've quantified it before, but since this is on recording, why don't you just elaborate for everyone again, and then we'll give everyone an opportunity to do that.
Okay, sure. I like my outside target to be 4 to 1 at least, but I like my inside target to be about 1.5 to 1. And that just basically means I look at the situation, I see the setup in terms of where I feel extremely confident it's going to go. So the initial move, I want to see that put me in a situation where I've already got 1 to 1.5 in the money. And I felt, for instance, in this morning's play, that I would get 50 to 60 ticks in the money really pretty easily. So 40 ticks seemed about right. It also put me at what I saw as a rough falsifiability point, because that would have brought the market basically above yesterday's highs, to the test of yesterday's highs. So I saw that initial little pop to the upside as an opportunity. I believed that I saw signs that we were running into resistance again, and that we would Drano out the bottom of that pattern, at least through the very initial knee-jerk lows that we put in place off the bell. So when I see it pop up there, I figure there's going to be some order flow coming in right away. We've got some decent headlines. And if it gets above yesterday's highs, I don't want to be in it anymore. So I've got 40 ticks to yesterday's highs, and I believe that I see a bump down through those early lows right off the open is going to give me about 50 to 60 ticks in the money. That's a good setup to me. That's a starter position. Since I've got a market bias right now to move lower, maybe by another 200 or 300 ticks, that's a great situation to be in. I've got my falsifiability. I've got my initial kicker move that puts me in a situation where I can maybe scalp a piece, move my stop up, really protect and take away the downside, and still open the door to those much bigger gains. I like to put myself in that position over and over and over again. It's not necessarily a specific methodical ratio, but I always want to be able to know I get in with the idea that I can get that initial move to put me in a good situation. I call it a power position. I like to be in power positions. I like to get that initial move. I like to adjust my stops, maybe scalp a piece, and then have the door open to much bigger gains.
Hey, Brett, I have a question, though. Today, if
Sure.
I'm not mistaken, you were short all three major indices, right?
Yes. Yes, that's correct.
Okay, so back when I traded bonds, we would call something like that the Texas hedge. So you were very, very bearish based
Well,
on
I
these setups.
it's like I was watching a battle going on, and I saw a particular battlefield, and I was watching the armies, and I could tell which side was going to win. And, we started to march across that battlefield, then we got to the edge of the battlefield, and there was a whole new army sitting there that, showed me that I was wrong, especially on the NASDAQ. So there was an inside pattern structure that had served me well in the Dow short. I'm well in the money on the S&P short, and I put on the NASDAQ. It was relatively strong, but then when the NASDAQ is relatively strong, that can flip real hard because you've got a lot of that sort of retail money that can be holding those stocks up and they can really flip to the other side of that equation. So I've seen that as a swing factor position a number of times, but they held. I mean, when we got to the edge of that, we moved about 4 or 5 points in the money on the NASDAQ short, and we broke the sloped line. And one of the things that I was going to talk about earlier, one of my favorite patterns is a shallow sloped line break. And we bounced off of that sloped line, if you look at like a 1-minute chart on the NASDAQ, bounced up, made a lower high, and started down through it. We broke the sloped line, and there was just a big bid there. So that just chased me right out of that. I still got the other two, still well in the money on the other two. But the NASDAQ, that bid was there.
All right, anybody else want to chime in on their overall risk-reward ratios?
Yeah, I'll go in next. So I'm always starting off with basically a 1-to-1 ratio, and I know that's not what anybody ever says you should be looking for. But again, I take partial profits, and I'm more of a swing trader. So my theory is I'm going to basically trade in relationship to the risk that I have on everything. So if I'm going to risk $3 on a trade, a swing trade, then my first stopping point is going to be somewhere around a $3 profit. And when I get that $3 profit, I'll trim back a third size of a position, or depending on how the overall market is, if I feel like it's too overbought or things are going to roll over, I'll take off half the size. And then I'll raise those balance stops up towards my break-even point. And then from there on out, I think it's just free money. I let the market do what it does best, and hopefully I can ride that trend going forward. Now, if I go 6 points in the money, obviously that's going to be 2 times my initial risk. And then I'll just trim a little bit, maybe say a quarter size or something else like that. Again, depending on how the overall market's behaving. But generally speaking, I'm going out there just looking for like a 1-to-1 ratio initially to take in a partial profit and then tighten up all my stops towards break even.
And Gavin, it seems a lot of times in your futures trades, you have a pretty defined risk. It looks like you go after, your initial risk is about 6 points initially, and then would that imply that you're looking for some of the same type of thing that Scott is, taking some partial profit at 6 and then letting the balance ride, or do you have a different strategy?
Yeah, no, you're pretty much right on tip there. I mean, I'm basically looking more at a 2-to-1 inside target for the most part, and then and something where I can get 1-to-1, not relatively easy, but I like it to be a lot better than a 50-50 coin toss, obviously, to get that 1-to-1. And I'll be quick to bank a profit if I do get that move on what I've risked. I did something similar with Square today. What I like to try to do is find setups where I could do a 2-to-1 risk reward where the risk is based under a pretty nice support level. For instance, for Square, it was obviously that initial dip down to 73.50. I was able to get a stop well under there. As Brett was just talking about, I took that S&P short right before I think he got in on the Dow, and I was laughing with you about it, Jim, because I follow Brett a lot, so a lot of my setups that I do probably are similar ones to what he's looking at, just because I've been following him with his futures trades for so long. That it was a setup where I felt I could get a quick 6 points down to that set, or 7 points down to session lows, which was the 6 points that I was risking. I had that nice overnight resistance level to kind of protect my stops on the short above at that 27.95 level where I was at. And if I'm right and I get the break, then I've got a good chance of getting a lot better reward out of it. If I'm wrong, then I'm taking out at a pretty manageable loss, and I'll just kind of continue to keep following along. But I'm always looking for that 2-to-1 generally at a minimum, with my risk really having a strong either support or resistance level, depending on if I'm long or short.
And that just leaves.
And that was event trader. Just guys, we need to identify ourselves more.
Yeah.
I see some feedback's just trying to figure out who's talking.
Okay, yeah, sorry, event trader there.
So that leaves you, Scalp. What's your risk-reward profile look like?
It's a good question. I'm looking for big gains, pretty much, so, I'm a little bit different than everyone else, I think. I don't mind scaling into a position that I feel very comfortable with based on research. Some of these names I'll research for 15, 20 hours for weeks and days and months, and I don't necessarily care that people are selling them. If there's value there that I think can be realized over a period of time, I'm okay owning a lot of it, and I might sit on it for a while. So that's on the kind of long-term spec side. On the shorter time frames, what I'm usually doing is I'm always starting off with basically a half position just so that I can scale into it, and I'm looking for at least want a 1-to-1, but I know that as I'm able to scale into price into the stock as price decline, if I'm looking at a long, I'm going to have a better overall average price, a larger position. So that 1-to-1 ratio works for me, especially on a scalp basis. Non-scalp, I'm typically looking for 20% at least and targeting triple digits. And I'm usually willing to risk maybe 20% to take on that, to go after that opportunity.
I think one of the key things that you guys do, even if the risk-reward ratio doesn't seem from just on the surface that it's huge, what you guys do often is move your stops very quickly. So if it goes in the money and it's in your favor, well, then you're protecting what you already have gained. Or in the case of chart trader, I know a lot of times the trade will move into a place where you don't necessarily want to take profits, but you definitely don't want to lose any money or a very small amount of money in that particular trade. And I think what happens then is your risk reward ratio becomes that much favorable just based on a short period of time. So therefore you can let that winner run even longer with minimizing that risk. So timing of moving that stop and assessing the risk in that moment is something that everyone needs to take into account as well.
And I would just repeat my mantra that we talked about yesterday. Close the door to big losses, open the door to big gains, and let the universe take care of itself.
Well, amen to that. I think that's a good place to put things on hold. We got a lot of good feedback that the listening community really enjoy these, and I think that's going to keep encouraging us to get on here. I apologize to all the listeners if we didn't respond to your question. We just couldn't get to them all. We got to let these guys get off the horn and make you guys some money out there. So with that said, I want to thank everyone for joining us today, and for sure, we'll be back on, and I'm going to keep a list of these questions, and we will certainly circle back on these, and we'll probably have these maybe once a week or so, time permitting. So thank you, everyone, for joining us today. Gentlemen, as always.
Thanks a lot, Jim.
All right.